tell me just some basic information that needs to be provided when you're having a tax return completed?
Sure. So a lot of accountants use digital platforms these days. So a lot of times we'll have lists of things, so you can follow that list. That's very helpful. Sometimes there's a list of questions. So again, you can follow that list. But anything that has a tax form look or a number on it, so you might see a form W-2 or a 1099 or a 1095, and you might not know what any of those things are. That's okay. Put it aside and give it to your accountant or upload it to the digital platform. If you're not sure, just put it in the pile. Your accountant will not use it if they don't need to.
Can you explain the difference between deductions and credits and give some examples?
Sure. So a deduction is just that. It's a deduction from income. It reduces your taxable income. So things like charitable donations would be a deduction. Home mortgage interest can be a deduction. Other taxes paid, like real estate taxes paid, depending on your personal situation. Credits, on the other hand, are a reduction in the amount of tax due. So after you calculate your income, you calculate your tax due. And if you have credits, you reduce the amount due by your credits. So things like what you might have heard of recently are energy credits for clean vehicles. That would be an example of a credit. Some people might have mutual fund investments that have foreign income. So many times we see foreign tax credits coming from mutual fund, and that represent tax paid somewhere else. So you get a credit for that on your U.S. return.
So one thing I think is a little less commonly talked about is the net investment income tax. Can you tell us a little bit more about what that is and who it applies to?
Sure. So the net investment income tax was established as part of the Tax Cuts and Jobs Act, which came into effect in 2018. It is a surtax on passive income. That's income such as interest, dividends, and capital gains, which are not part of an active business. The tax is 3.8%, and you're only subject to it if you exceed certain thresholds, but it cannot be offset by credits that we just talked about, such as the foreign tax credit. So it's just this weird little surtax in the rules that applies to many investors with savings income or mutual fund income.
So if we transition to tax strategies, I mean, it's obviously something that you all do frequently. We work together a lot on things like that, just because some of those strategies can involve investment accounts, retirement accounts. What are some of, I would say, the most common strategies that we use if, maybe your income is higher than expected or it's lower than expected?
So the first thing we want everyone to do is to focus on maximizing your retirement plan, 401k plan, or a private pension plan, or IRA, cash balance plan, whatever it is that you might have. The second thing we can talk about is capital gains, tax loss harvesting, or resetting. So if your income is higher or lower, depending on what happened, you might want to rebalance your portfolio. You can create taxable gains or losses.
And I think the strategy part is really where wealth management can partner with the tax preparer to help achieve better after-tax returns. So one way we do that is by looking at a tax return and seeing, should you be invested in taxable or municipal bonds, or maybe it's a combination of both. Another way we do that, like you mentioned, is through tax loss harvesting. This year is a great example of that, right? Unlike last year, where the market went up and up and up all year, or as Jason Staley likes to say, up and to the right, we had no opportunities to harvest losses. And of course, everybody saw large capital gains. This year, we've had the opportunity to do a lot of tax loss harvesting, which of course that can carry forward into future years that gains are high and the market is recovering. Capturing losses, again, can make a big difference on the tax return. Can you tell us more about tax losses and how they can benefit our viewers?
So typically we do see this with capital gain property. So again, I have investments in the market or mutual fund investments. And so maybe some of them go up like last year. This year, a lot of them went down, but there's still some winners and losers when you hold for a period of time. So let's say I had something and I decide to sell, like I own some Twitter stock, and when Elon Musk said he was going to buy the company, I'm like, yay, it went up, I'm selling, I'm going to capture this gain. And now I've got this big gain. What do I do with it? So maybe I have some other things that not so great. And I can harvest that loss and offset my gain in that same tax year. So I don't pay tax on that Twitter stock sale. And I get to utilize the gain or the loss that I generated from another investment. You can also create these losses. They'll carry forward. If you can't use them in the current year, you can deduct $3,000 of capital loss in excess of capital gains. And then anything else can carry forward for future years. So let's say this year you create some losses. Maybe you're invested in a few things and you're waiting to see how they pan out. Next year, the market recovers and you're like, hey, good time to sell. Now I can shelter that gain because I've created these losses and I've been able to reposition my portfolio accordingly. So great techniques. We always work with financial advisors on that and work together to see how we can best plan for our clients.